Bernstein has come out with a note on wealth management stocks. The likes of Nuvama, 361, I believe Anand, Rathi. Harsh is here with more on that. Harsh, good morning.
Good morning. You know, what stands out is the kind of growth numbers that are being penciled in by Bernstein, and this is despite the run-up in some of these stocks as well. So let me first start off with what Bernstein believes in terms of the industry as a whole. They believe 20 to 25% growth CAGR in assets under management, at least for the foreseeable future to FY28 at the very least. 20% earnings growth is what they're penciling in, and a 20% ROE over the next few years. Those are the three real pillars on which they're basing this note. There is a growing demand for professional advice, especially among HNIs and UHNIs, is what they're saying. Now, in terms of Nuvama, they've given this an outperform rating, 26% upside, 9,790 being the target price. They're saying that Nuvama is in a plethora of services that gives them an edge: asset services, wealth, private growth, and AMC. They are across those value chains. They're expecting a weak FY26, but FY26 to FY28, they're expecting a 21% growth CAGR and a 25% PAT growth. In terms of what could be one monitorable, they're saying that the possible open offer of the promoter exiting could impact the price dynamic in the near term. So that's one monitorable. 361, they're saying it's the number one wealth manager, number one in alternatives AMC business. They're penciling in a 20% pre-tax profit growth and a 20% ROE all the way through FY28. They believe that the other levers, global product access and predictability in broking revenue, are comfortable with regard to the business as a whole. The ultra high net worth business remains juicy, is what they say. Pressures are rising though, and RM attrition, which is relationship manager attrition control, is going to be critical going forward. Anand, Rathi, they have a market perform, negative 2% return is what they're penciling in, 2580 being the target price. They believe that there's a superior growth engine here, but the risk is a high reliance on attractive but complicated products. One-time fee is what limits the valuations, and the group NBFC derivatives is a risk. So all of those in focus on the back of this note.